At this precise moment on this Thursday, December 4, 2025, Datavault AI Inc., ticker symbol DVLT, is trading at exactly $1.80 USD. We are looking at a slight intraday pullback, currently down 0.029 points, or approximately 1.56% for the session so far. If you are scanning the penny stock gainers and losers on your Fidelity mobile app or tracking small cap volatility, this red number might look like just another day of churn for a sub-$2 stock. The chart looks messy, the volume is sporadic, and the general expectation from the smart money on Wall Street is one of extreme skepticism. They look at this ticker and see WiSA Technologies, the old audio component company that struggled for years, wearing a new AI mask. The narrative is that this is a classic pivot grab, a dying hardware company slapping Datavault on the door to chase the AI and Web3 hype cycle. They expect it to be a buzzword soup with zero substance, destined to dilute shareholders into oblivion while chasing trends that have already peaked. But here is the reality that is starting to quietly terrify the shorts and confuse the skeptics. Datavault AI is not just changing its name, it is successfully executing one of the most aggressive asset transformation strategies in the micro-cap space. While the market is pricing this at $1.80 USD, treating it like a distressed relic, the company has just confirmed a revenue guidance raise for 2026 to over $200 million. Let me repeat that, $200 million. We are looking at a company trading at a fraction of its projected near-term revenue. This is not a concept stock anymore. They are signing definitive 8-figure contracts with entities like Scilex Holding and MTB Mining. The disconnect between the failed audio company stigma and the high-growth data utility reality is creating a valuation gap that is frankly absurd. You are looking at a stock that is priced for bankruptcy but is guiding for hyper-growth. To understand why this $1.80 USD level is a battleground, you have to look at the trust barrier. Investors have been burned by pivots before. When a company shifts from wireless sound to data monetization, the natural reaction is to roll your eyes. This skepticism is what creates the ceiling at $2. Every time the stock tries to break out, the bag holders from the old WiSA days sell into the strength and the doubters short the spike. But the floor is rising. Why? Because the quarterly reports are starting to validate the thesis. The Q3 2025 revenue growth of 148% year-over-year is not a typo. It is the first tangible proof that the new business model, monetizing data through information data exchanges, is actually generating cash, not just press releases. Let's dig into the core of this new business model because it is complex and often misunderstood by those using generic investing sites. Datavault AI is effectively building a marketplace for real-world assets and intangible data. In the past, if a biotech company like Scilex had valuable data about patient outcomes or drug efficacy, that data just sat on a server. It was an inactive asset. Datavault comes in, uses its brain power and ADO tech, ironically derived from their acoustic patents, to structure, value, and tokenize that data so it can be licensed or traded. The recent $10 million licensing deal with Scilex to monetize genomic and therapeutic data is the blueprint. They're turning static information into a tradable commodity. The expectation was that this was sci-fi vaporware. The reality is that checks are clearing. We also have to talk about the acoustic science legacy. For years, this company, as WiSA, spent millions developing high-fidelity wireless audio tech. The market wrote this off as a failure because they couldn't get enough consumer adoption against Bluetooth. But here is the pivot twist. Datavault is now repurposing that spatial audio and data over sound tech for data verification. They are using sound waves to verify location and identity in their data exchanges. It's a brilliant, if bizarre, recycling of intellectual property. They didn't throw away the old tech. They weaponized it for a new war. This sunk cost becoming a competitive moat is something the algorithms trading on interactive broker stock trading platforms are struggling to price in. Now, I want to pause and get your take on this data tokenization concept. Comment below if you think selling data rights is going to be the next massive asset class, or if it's just a fancy way of selling cookies and logs. Are you buying the RWA narrative, or is it too abstract for your portfolio? Let's look at the mining deal, because this came out of left field and shocked the bears. The $7 million deal with MTB Mining to digitize raw earth assets like gold and copper reserves is a signal that they're moving beyond just digital data. They are entering the commodities sector. By creating a digital twin of a gold mine's reserves, they allow the mine owner to monetize that asset on the blockchain before the gold is even dug out of the ground. This is financial alchemy, yes, but in a liquidity-starved world, mine operators are desperate for this kind of capital efficiency. If Datavault becomes the standard for digitizing commodities, the total addressable market, TAM, is in the trillions, not billions. However, we must address the dilution death spiral risk. This is the specter that haunts every penny stock, and Datavault is no exception. To fund this massive pivot, they have had to rely on convertible notes and equity financing. The recent filings show significant insider activity and complex financing structures. For a retail investor using Robinhood investments, these structures are dangerous. If the stock price drops, the terms of the debt often become more toxic, forcing the company to issue more shares to pay the lenders, which drops the price further. This is why the stock is down 1.56% today despite the good news, because the market is terrified of the share printer turning on. The $150 million investment agreement from Scilex is great, but how is it structured? If it's equity-based, it means more shares flooding the market. You have to watch the share count like a hawk. Let's talk about the institutional flows. Currently, ownership is heavily retail and insider-dominated, but we're seeing small blips of interest from quant funds that track revenue velocity. When a company posts triple-digit revenue growth, it pops up on the screens of SoFi Active Investing and Fidelity ETFs that target micro-cap growth. We're in that awkward phase where the momentum traders are interested, but the value investors are still too scared to touch it. This transition period is usually the most volatile. A single quarter of missed expectations could send it back to $1, but a beat could send it to $4. The technical analysis on the daily chart at $1.80 USD shows a consolidation wedge. The price is getting squeezed between the 50-day moving average, resistance, and the recent support lows, support. The volume has been drying up over the last few days, which typically precedes a breakout, either up or down. The RSI is neutral. This is a wait for the trigger setup. The trigger will likely be the next press release about the closing of the Scilex investment or a new partnership in the biotech exchange. We should also consider the management factor. CEO Nathaniel Bradley is pitching a vision that requires a suspension of disbelief. He's effectively telling you that he can turn a speaker company into the NASDAQ of data. It's a founder mode pitch. If he pulls it off, he's a genius. If he fails, it's a cautionary tale. The fact that he's secured partnerships with publicly traded companies like Scilex, SCLX, lends him credibility that most OTC penny stock CEOs do not have. He's operating in the regulated public markets, not the wild west of crypto unregulated exchanges. This distinction matters for those considering online investment in this sector. Let's shift to the future outlook, the 2026 scenarios. Scenario A, the data baron. Datavault successfully launches its biotech exchange and commodities exchange. The revenue hits the $200 million guidance. The market re-rates the stock to a modest 5x sales multiple, which is typical for high-growth data SaaS. That puts the market cap at $1 billion, implying a stock price of $4 to $5. This is the multi-bagger return that justifies the risk. Scenario B, the dilution trap. The revenue grows, but the cash burn grows faster. They have to raise $50 million in equity to keep the lights on, diluting early shareholders by 50%. The stock churns between $1 and $2 forever, never breaking out. Scenario C, the integration failure. The technology doesn't scale. The data tokenization turns out to be legally unenforceable or technically flawed. The partners walk away. The stock returns to its shell value of $0.30. For those of you managing Fidelity wealth management accounts, this ticker is likely unsolicited, meaning your broker won't recommend it. It's too small, too risky. But for the self-investing crowd, this is exactly the kind of asymmetry you look for. You're buying a call option on the execution of a new business